Good evening. This is Ken Long from Tortoise Capital with a review of the daily trading plan for Monday. We're looking at a bullish volatile market. On an annual basis, it's slightly high at 64. It's high end of neutral on a weekly RSI. 92 on the 10-day index puts it at overbought on a short-term basis. Percent stretch above the 200-day moving average at 11.09% puts the market in bullish conditions with a nice cushion between current prices and sideways. The slope of the 50-day moving average has improved to 0.26%, but that's still rated as red, which is slightly bearish. ADX has pulled down below 25 to 24.3. Minus DI, as you can see, is still above plus DI, which is an indication that the strength of trend is downward, although the downward trend has started to weaken this past week. ATR percentage at 1.46 puts the market in volatile conditions, and you can see that we're still above one standard deviation higher than the 180-day average, although it has backed off considerably this past week. No signals in the overreaction and channeling systems. You can see the daily pivots. I want to take a look at the gap stat over the last 30 days for SPY. You can see that 17 times out of 30, the market has gapped down. 7 of those 17 times it has continued to drop, and 10 times it has reversed. 13 times it's gapped up in the last 30 days. 9 times out of 13, or 2 to 1, the gap up has been followed by an increasing gains, a higher follow-through of averaging 0.4%. The 4 times the market has gapped up and then closed lower than the open, it's been a full 1% fail. So a gap up and fail although it is not as common as the gap and go, has been rewarding us for framing that trade. You can see that on the range stat for SPY, the maximum intraday normal move has been 1.73%. And the 10-day index time series, you can see, has gone from oversold up into overbought for the last couple days. 10-day max pain, looking at the Dow 30, Intel, General Electric, IBM, Cisco, and ExxonMobil among the ETFs. The VIX, semiconductors, Japan, gold miners, and Germany. No pattern trades to speak of because of the gains from last week. The finish was strong. Taking a look at the daily tactical, the percent winners in the Dow: IBM, ExxonMobil, AT&T, United Technologies, and Chevron. I'm interested in Cisco because it's a 10-day and a 3-day max pain, but was not a percent loser on Friday, and so that was some of technology perhaps rebounding. I'm interested Bank of America, BAC, which is also a 10-day and 3-day max pain, was a 1-day max pain on Friday, losing 1.04%, excuse me, which suggests to me potential for like a short-term washout. Among the ETFs, natural gas has been doing well since that reverse split, and technology, the Qs, did well also. Europe, Eurasia, and Japan suffered on Friday, and I'm looking for more weakness in those sectors. Summary of the pattern trades among the Dow 30. You can see there's a handful of dojis in Home Depot, Disney, Pfizer, American Express, Intel, and Johnson & Johnson. Bank of America is the number one max pain range compression, followed by Cisco. Then Intel, General Electric, and Procter & Gamble. So I'm going to be stalking Bank of America pretty closely. Not only was it a max pain range compression, the financial sector has been among the that's like the worst sector in both the U.S. and the global And so I'm looking for a recovery bounce out of those. You can see just how bad Cisco has been suffering in the number 2 position for max pain range compression. Among the ETFs, a lot more dojis based on Friday. It's not surprising when you take a look at Friday's pattern in SPY. It's made a nice bounce off that 10% correction, and it's pulled back like 7 or 8% already, and finished up in a doji, so the market's at a perfect hesitation point. The VIX, utilities, then finance and real estate, and then gold on the max pain range compression. I'd be looking for some follow through in natural gas, which was a percent winner along with technology. In technology, I'd be looking at QLD. I'd be looking for Hewlett Packard to make a rebound and to play catch up, and then looking for strength in Cisco and Microsoft as well. All three of our favored technology large caps are in a position to do well. 30-day regression line, you can see the bounce. The percent stretch has come back to 1 standard deviation above average for SPY. And the slope of the 30-day regression line, the time series, you can see it has made a negative 2 standard deviation move below average and now hooked up and has now crossed over its 10-day moving average. That's been the sign of a potential change in trend, and so a rebound continuation and then going back up to test the swing high at 135 is absolutely within range right here, and that's what the slope of the regression line is telling us, that it wouldn't surprise us to see a powerful move here. The last time it did that, you can see right here, it was down around 105, and that kicked off this long first leg up out of this pretty much historic move inside SPY. Now, it's true that there was a little pullback 3 months ago, followed by the second leg up. This pullback has been considerably worse, but it's already bounced back to the previous congestion zone. And so that may be enough of a sideways movement for the U.S. to take off here. And the technology weakness lately has postured those large cap techs to have some room to recover, and they may be the next leaders. So I can make the case equally well for both sides of the trade, and I expect it to be more volatile. A quick look at the range stats, just a summary for you, and also the gap statistics of the big indexes. The Dow 30 quality reports and the ETF quality reports. I'll leave those for you to review. You can see the bounce in technology here. Taking a look at this is the relative strength of the big indexes compared to SPY. So again, we take the slope, we take the 30-day regression line slope for each of the indexes, subtract that of SPY from each of them, and then what we're left is a market neutral relative strength score. And you can see how quickly the trend has changed inside technology, which was 1.5 standard deviations below SPY and is now 2.5 above. So we had quite a rebound in technology this past week. And you can see the commodities have turned down and started to fall. And the internationals are all suffering. So this is looking like a U.S.-led rebound right now, and that's reflected in the world market model, and looking for more strength in technology. And that's why I'm really liking the stock on Hewlett Packard, Intel, Microsoft, Cisco, because all of those have lost so much lately that they're well postured to rebound and test their swing high. So let's keep an eye on the large cap techs. Inside the safe zone calculations for Dr. Elder, the Qs, mid-cap growth, and a balanced NASDAQ 100 were the strength leaders on Friday. So I'm looking for more continuation play on those. the top winners and losers just over the last 10 days and 30 days for you to review. A summary of the daily pivots for your data. The holding X days report, you can see that the rebounds of the last 5 and 10 days have all been substantial. Only Japan is really suffering right now. U.S. real estate to a certain extent. The Z-scores on the 10-day are all below, well below 1, as most of them are on the 5 days, and so that says the rebounds have been substantial but not extraordinary. So that's why I believe there's still room for more bounce on the upside. And that's everything I want to cover on the daily report. Good hunting.